Thank you for joining me. I'm Alex, and I would like to talk to you about Progressive today. So, Progressive does insurance, and they're one of the biggest in the US currently. Certainly not too many at the same level. Obviously, Geico's up there at this point. So, current price is $70.53, which gives the market cap of $41 billion. Current dividend yield is 0.56%, which is not a whole lot, especially considering the payout ratio is 53%. Current revenue up a lot, $32 billion, earnings $2.6 billion, up even more, and that gives them a PE of 13. So PE certainly looks good, dividend certainly does not, but, dividend is always a nice bonus, even if it's tiny. Total assets, $47 billion. Total liabilities, $36 billion, which gives them a total stockholders' equity of $10.8 billion, which is up, which is always a good thing. So Warren Buffett famously loves insurance, and I couldn't disagree with that, really. So obviously, this is a very stable business for a few more years at the very least. And revenue going in the right direction, earnings going in the right direction, equity going in the right direction. PE looks pretty good. So honestly, I don't see too many things here that would concern me about buying this company. So to go far into the future, there's going to be a lot fewer accidents once autonomous driving is more of a thing everywhere. How long that's going to take is kind of up in the air at this point. According to Tesla, it's going to be a year. According to everyone else, it's going to be probably a decade. So that whole thing may or may not come sooner or later. Tesla just entering the market with their own insurance, obviously also a risk factor. But I don't see Tesla ever insuring anything that's not made by them. So I think that for currently about 98% of cars built, that's not a problem or a risk factor. So with that said, even if the accident rate goes down significantly, that doesn't necessarily mean that the premiums go down significantly. Obviously, they would eventually, but for the insurance, there would be this glorious period of a lot more premiums versus a lot fewer accidents. So that's kind of a bonus just before the business model gets a lot worse. Clearly, if Tesla ever becomes a big player on the market, saying that their market share is millions of cars, then that would be more of a problem because they would drive the cost of insurance down a lot for their cars, not necessarily anyone else. But once you're there, you can kind of easily expand to pretty much every other vehicle. Just not sure if they want to. I would assume they don't. So as far as risk factors go, I don't think that there's anything new out there besides anything I've mentioned. So very safe business. I would say that the safety of principle is pretty much a given, and very stable, good revenues, good earnings, good PE, good balance sheet, dividend is So to sum that all up, I think that for a dividend investor, you might want to get something with a slightly higher dividend. Especially at this point, there's quite a few companies that pay upwards of 3-4% that are still very safe companies. And even at the a 2.5% dividend would be 5 times what you get here. The difference is that the growth is not quite there. So if you have a horizon of about 5 years, I would say that for a dividend investor, it probably doesn't make sense, because even if the earnings increase significantly over the next 5 years, the dividend is still going to be far less than the 3-4% you kind of would like to. So I don't think that a dividend investor should really invest in Progressive right now because, as I mentioned, insurance might not be quite the same thing in 5 to 10 years as it is now. For a growth investor, I think that 20% growth is good for the company, but not really for a growth investor. You kind of want to get to the 50 to 100% range. So for a growth investor, I don't think this is a company for you either. But for a value investor, I think the PE is pretty good. The equity or the balance sheet is pretty amazing. And the dividend is kind of a bonus on top of that. So you have the growth, the PE, the balance sheet, and the tiny bonus of the dividend yield. So for a value investor, I think that it makes sense to even hold a fairly large position in Progressive at this point. And so I would recommend, if you're a value investor, you should probably look into this company and do some more research, but it looks very promising. That's it for me for today. If you like this video, make sure to subscribe. I'm coming out with more videos every day before market open. I hope you have a successful day.